Hello students, we are here with the chapter 9 financial management, which is part 6. Okay, so already we have discussed many things related in the previous 5 videos of the chapter. So in this we'll cover the major part of the syllabus. So first one is point to be discussed here are meaning of the working capital and the factor affecting the working capital. So let's start with it. Meaning of the working capital. Working capital refers to the excess of current assets over current liability. What does this actually means? Working capital refers to the excess, means more of current assets over current liabilities. So here is a mathematical formula for it. Working capital is equal to current asset minus current liability. This is what the meaning of working capital. Let's go ahead. Now gross working, these are the types of working capital. Okay, so the first one is gross working capital. This refers to the investment in all current assets. Okay, what are the current assets? Firstly, let us know current assets are those assets which can be converted into cash into a short period of time. So for example, we can take cash in hand, cash at bank, debtors, marketable securities, finished good inventories, bill receivable, work in progress, raw materials, and prepaid expenses. These are the some examples of the particularly the current assets. Okay, so net moving ahead is a net working capital. This refers to the excess of current assets over current liabilities are to be paid within a accounting year. Okay, bills payable which is payable within the year. Okay, within the accounting year, these are termed as a net working capital, or creditors which we have to paid within the year. This was regarding the two concept or the types of working capital. Now moving ahead in the chapter, we will discuss the factor affecting the working capital. First one is the nature of business, scale of operation, business cycle fluctuation, season factors, technological production and production cycle, credit allowed, credit available, operating efficiency. So the first one is the nature of business. Let us discuss in detail regarding the matter. Nature of business. This type of business firm refers to the involvement in this the next consideration while deciding the working capital. Okay, in case of trading concern or retail shop, the requirement of the working capital is less because the length of operating a cycle is so small. Okay, just take an example. Okay, here what example is given. Retail shop required less operating capital, whereas you compare to a big firm like malls and all, they require a huge fund because they have a variety of product installed in their particular shop. Okay, the next point to be discussed here is a scale of operation. The firm operating at a large scale need to maintain more inventories, debtors, etc. So they generally requires a large working capital, whereas the firm operating for a small scale requires less working capital. This is an important aspect of operation. See, the large scale needs to maintain inventory and debtors. Okay, large. So generally they require a large working capital. Okay, whereas the firm operating a small scale required less working capital, because if my business will be small, I will be requiring less working capital. Now moving ahead, next one is a business cycle fluctuation. Okay, fluctuation we all know, coming down, coming up. These are termed as a fluctuation. During boom period, the market is flourishing, so more demand, more production, more stock, and more debtors, which means more amount of working capital is required. Okay, means during the period of boom, okay, a person required more production, more demand, more stock, more debtors, which generally result to the more requirement of working capital. Whereas during the depression period, low demand, low inventories to be maintained. Okay, this has to be maintained, less debtors, so less working capital will be required. Okay, we already know there are two periods. First one is boom period and next one is a depression period. Okay, so moving ahead in the third point, we will discuss about the seasonal factor. The working capital requirement is the constant of the companies which are selling goods throughout the season, whereas the companies which are selling the seasonal goods require huge amount during the season. As amount of demand, more stock has to be maintained and fast supply is needed, uh, whereas the during off season, slacks off season, demand is very low and less working capital is needed. Just take an example of winter. Okay, a winter. So in winter, the requirement of the particular thing is high. Okay, the requirement of a particular clothes are high. Winter clothes are requirement is high, so a particular season is there, no one wears throughout the year, so the requirement will be high, working capital requirement will be very high at that particular of time. Okay, this was regarding the seasonal factors. Moving ahead, technology and production cycle. If a company is using labor intensive technique of production, then more working capital is required, because company need to maintain enough cash flow for making payment to the labor. Okay, whereas if company is using machine intensive technique of production, then a less working capital is required, because investment is machinery and fixed capital requirement, there will be less operative expenses. Okay, if I am using the labor intensive technique, I have to pay back to the laborers. Okay, they are working, I have to pay. But if I have already invested in the fixed capital in the form of machinery, so the requirement will be little less in the operative expenses. Next one is a credit allowed. Okay, credit policy refers to the average period of collection of sales proceed. It depends on the number of factors which are credit of the client, industries norms, etc. If the company is following the liberal credit policy, then it will require more working capital, where if the company is following a strict or short term credit policy, then it can be managed with less working capital also. Okay, if credit policy refers to the average period collection. Okay, sales proceed, it depends upon the number of factors, such as a large number of factors are required for that. Okay, industry norms, clients. If a company is following liberal credit policy, then it will require more working capital, because you will be giving a lot of credit to the particular organization or person. Okay, next one is the credit available. Another factor related to the credit policy is the how much and for how much period a company is getting credit from its supplier. Okay, from how much I'm getting from credit facility I'm giving to the supplier. Okay, if suppliers of the raw materials are giving long-term credit, then the company can manage less amount of working capital. Okay, means they are ready to give a lot of credit facility to you for a year, then I will be requiring less working capital. Whereas if the suppliers are giving only short period credit, then the company need the more working capital to make payment to the creditors. Okay, means 1 month or 2 months, then I require to maintain the good capital structure of my company. Next is operating efficiency. This is the last part of the video. The firm having a high degree of operating efficiency requires less amount of working capital as you compare to having a low degree of efficiency, which requires more working capital, whereas the supply of raw material is smooth and the firm need to maintain a large inventory to carry the operating cycle smoothly, so they require more working capital. See, if anything is less, means if you have got a lot of order and you are not able to satisfy it. Okay, so if the raw materials, if you are not having the raw materials, the business will not run in a smooth flow. Okay, that will create a big burden for you. Okay, you cannot generate the profit also if you are not having the raw materials. Okay, this was regarding the operating efficiency. So this was the last part of the chapter, and with it we have completed chapter 9, the financial management. And we have already discussed the six videos regarding this chapter, so it was a big chapter and a very important one. Thank you for this.